Goldman Sachs is forecasting the S&P 500 index could rise by 5% to 3,250 in early 2020 as the U.S. bull market enters its 11th year. But the bank also warns that rising political and policy uncertainty will likely keep the index range-bound for most of next year. Now, Goldman says that means 3,400 at the top level if there is one clear political party controlling Washington, D.C., the bottom level, 2,600 if the government unifies across party lines. Joining us now is Dan Wantrobski. He is the research director at Janney, Montgomery. Scott and Dan, it's interesting when you look at the headline of this note, united we fall, divided we rise. It's usually the opposite, right? What exactly are they highlighting here, and do you agree?
Yeah, so I mean, look, it's always tough to give these projections for the year ahead. And in our environment right now, I think even doubly so. We have a ton of macro and geopolitical uncertainty out there. And really, for a lot of 2019, based off that macro and geopolitical uncertainty, our markets really below the S&P 500 and Dow making new all-time highs. The rest of the markets have mostly been range-bound. If you look at the Russell 2000, which is doing very well today, or the small cap 600, these are benchmark indices that have been trading sideways through most of this year. So really what we saw was a concentration in U.S. large caps. And again, it comes back to that geopolitical and that macro uncertainty that exists. It's building a tremendous wall of worry for investors.
Dan, For much of the last few months, we've heard from a lot of analysts who've come on the show who say, look, don't trade the domestic political risk. As you point out, it's all about geopolitics. But now we're getting into the heart of the 2020 race come January. What do you see as the biggest political risk to the bull market if we're talking just the domestic headlines?
Well, I think it'll be a binary shock if you have some of the Democratic front runners moving up the ranks in terms of sentiment and voting popularity. And I think that could provide a little bit of volatility to the U.S. markets. But again, in looking at the history of the markets, one of the key functions that powers bull markets has less to do with our political process and more to do with big underlying drivers. And regardless of who wins the House next year, these drivers are still very much a part of this cycle here in the U.S. So beyond 2020 and any volatility that presents itself, we have big plans for the S&P 500 in this bull market. We think there is a very distinctive demographic cycle underneath this system that is powering the U.S. We think valuations are decent here. Stocks are not ridiculously expensive as they were in prior cycles. We think the credit markets and the financial system is functioning properly. And we think our central bank stands ready, willing, and able to supply this market with liquidity. And that's key. We always say, America runs on Duncan. We always say, U.S. stocks, the stock markets run on liquidity. When the Fed provides that, it is a tremendous tailwind, in my opinion. So you have the Fed backstopping the repo markets. You have a Fed that comes out and says, we are going to be accommodative where need be in terms of rate policy. And I think that could be tremendously beneficial to the U.S. market. So if we do have some election volatility next year, we're going to be looking at that as really a buying opportunity in a broader secular expansion here in the U.S., a broader bull market.
Dan, one of the big concerns from a corporate standpoint has been the pullback in investment. The Journal out with a story today talking about pullback from spending on equipment and other capital investment because of the uncertain business environment. We're talking about names like Harley Davidson, AT&T, and Target, all joining small businesses and putting the brakes on investment. What are you seeing on that front? We've heard on the one hand that, look, we're not hearing as much about trade, the word itself, in some of the most recent earnings calls, and yet that still seems to be the cloud hanging over a lot of these big names.
Yeah, absolutely. And so you bring up a good point. And again, it all circles back to liquidity, right? Liquidity can be provided to the markets via the private sector, and that's through all that CapEx spending. In any secular expansion, in any stocks bull market, that liquidity provided through CapEx spending from the private sector, that typically tends to be the best source. When there is macro uncertainty, geopolitical uncertainty, that private sector pulls back. because they don't know the future. They don't know how to plan for it. That is typically when the public sector comes in through monetary policy. See, that's what the Fed is doing here. On that pullback in CapEx spending, which I realize that article is today, but actually if you look at U.S. small business CapEx spending, that actually started drying up last summer, in the summer of 2018. And I think that was really one of the things that propelled elevated volatility in the U.S. small cap stocks. So with the Fed being that backstop, I think once we get past elections, U.S. corporations are going to be able to plan and be able to reinvigorate that CapEx spending. They were doing it at a good clip before last year. I think they are going to return to it once we get past some of this election uncertainty.
Good to get your insight on that. Dan Wantrobski, appreciate you joining us today.
Thank you very much.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.